Hi, I'm Ben Brooks. I work as an independent protection advisor here at Drewberry, and today I'm going to talk you through life insurance. So in short, life insurance is designed to pay out a cash lump sum in the event that you pass away during the term of the policy. So it's really important to note that there's a couple of different types of life insurance. They all work in different ways, and it's important to distinguish how they work so that you understand them moving forward. So you've got level life insurance, decreasing life insurance, whole of life, and family income benefit. So first off, we've got level life insurance. This is where you'll select a sum assured or an amount of cover, and then regardless of at what point you pass away during the policy term, you get that specific amount of cover. So the total amount of cover that you have at the start, it doesn't change. It stays the same the whole way through the policy. Next up, we've got decreasing life insurance. Typically, we would arrange this to protect against a repayment mortgage. So effectively, the way that it works is as you chip more and more away off of your mortgage and the mortgage amount decreases over time, your life insurance matches the outstanding amount on the mortgage. So over the course of the policy, the amount of cover decreases, which makes it a lot more financially sensible. Now, there's also whole of life insurance. This is pretty much fail-safe. So you don't set a term of the policy, it will literally cover you for the whole of your life. So regardless of what age that is that you die, it will pay out at that point, which of course has a lot of significant benefits, but it does make the policy a lot more expensive. And finally, we've got family income benefit. Now, this works in a slightly different way, in that you do still select a term and an amount of cover. You can take it as a lump sum payment, or alternatively, what you can do is have it pay out to you in a monthly payment instead. So it's worth mentioning as well, whilst we're on the topic of life insurance, that you can also add critical illness cover to it. So this works in a similar way, only that instead of passing away in order to qualify for the payout of the policy, you simply have to be diagnosed with a critical illness that's outlined on the policy to get the lump sum payment. So when establishing a need for life insurance, one of the first questions that I'd typically ask is, what is it that you're looking to protect? So usually a policyholder would have financial dependents, so maybe their children or somebody that they care for, someone that's dependent on their income and them being around. Secondly, it might be that there's a large outstanding debt or liability, like a mortgage, for example. So if that applies to you, then there's a very evident need for life insurance. And if you don't have any outstanding liabilities or debts or any financial dependents, then life insurance isn't a bad idea, but it just might be that there's a more suitable policy that we could look at. So it does vary. As a general rule, life insurance tends to be a more affordable type of protection. There's a lot of contributing factors though when we think about the premium. So the type of life insurance, first off, will have a huge impact. As we said, whole of life insurance tends to be more expensive, but mainly the amount of cover that you would like and how long you want that policy in place for are the two most important things to think about. And then your smoking status and your health, again, that's a huge thing. So there's a lot of factors. When discussing life insurance, it's really important to also talk about trusts. So as part of that, what you can do is write a life insurance policy into a trust. And there's a number of really key benefits that come with doing this. So first off, you as the policyholder can appoint a beneficiary, who's the person that benefits from the payout, and a trustee, who will effectively allocate the payout. Secondly, you are not liable to pay any inheritance tax, which stands at a staggering 40%. So that's massive in itself. And lastly, the payout doesn't form part of your estate, so you don't need to go through probate, which makes the whole process so much quicker. There's a lot of stigma, of course, within insurance that it's just full of jargon and it's massively overwhelming when it comes to knowing what kind of questions you need to answer and when they need to be answered. Going through an advisory brokerage can basically take away that burden from you. So it's our job to be able to understand the policy and to effectively hold your hand through the whole process. As part of that, we'll review your policy year on year to make sure that it's always fit and proper for what you need.